Hello friends, this is Rajat here, and we have seen today market falling drastically, and therefore uh, at the background of it, everybody is quite worried ki what is there for the markets, and there has been a free fall into the market. So the purpose of this video today is to see what the market fall has been, what are the basic reasons behind it, where do the investors stand, how the different asset classes have been performing against each other over these times. And believe me, today you will be having many startling facts for you. Yes, many startling facts for you जो आपने सोचा भी नहीं होगा. So many of the preconceived notions or thumb rules of investing will be shattered across, so that you will get a new insight or a new viewpoint to look at your portfolio, your investments, and the broader market per se. So let me here share with you the screen. So we have this window tab and all, and here it is. So now here, if you see that we are talking about the unseen market forces. So the markets have been there. What are the forces that are actually impacting the market and leading to the free fall? So this is what we are looking at. Standard disclaimers are there. So now here we are. So here if you see the first chart, here we are looking at the Nifty daily chart. Okay. So we are on the November 4th, and here is the big red candle for today. And we have seen here from this point, nearly by the ending of the October, if we would see, the market had been steadily falling. And there has been a fall of around 8.66% as we see it. So here is the Nifty. So therefore, you name the company, there has been a bloodbath across all the sectors and the segments that have come up. Now, therefore, what are the key factors? We know that there are a couple of global factors playing their role, like there has been US presidential elections. US Fed is taking a call around 6th of November whether they should cut the interest rates or not, because based on federal decisions to cut the rate, the Indians will again move ahead with the cutting of the rate of interest. If they do not do, then obviously it will be negative for the market. So if you see this, because this is always a monthly routine, and if you see the previous months, for the last 1.5 months, the first week has always been a volatile month on the backdrop of the Federal Reserve's monetary policy. So that is always there. Apart from that, one more concern that is there is the China's NPC, नेशनल पार्टी जो है उनकी कांग्रेस की. सो चाइना की, they are taking a call on the stimulus, whether they should do the stimulus or how much of the stimulus they need to do. So therefore FIIs and everybody is having eyes on that, because if China really goes very big on the stimulus, then the funds that have been moved out of India or many of the regions might flow into the China. So that is one more thing, because then obviously who is more hungry for the money, that is where the money will flow globally. So these are there, and obviously there has been an FII selling. Technically FII selling is because of the above three reasons and not the reason in itself for that matter. So these are the factors. However, the key concern जो यहाँ आपको देखना है वो ये है कि factors keep on changing. 2 months back the factor was of Iran and Israel conflict. Prior to that, around a year or so, 2 years back, there was a Ukrainian conflict being the center stage. Then before that, there has been a Korean issue, North Korean issue. So always and always there would be one factor or the other as far as the investment landscape is concerned. What matters for an investor is ki if these factors are there, how the portfolios are doing, how the markets are doing, what has been across asset relative performance of those things, and then from there you will take it up ki how my strategy should be refined. So that is how it should go. Now technically, if we look at this fall of 8.55 has been a momentous, you can say, the occasion in the equity markets, because it has broken the notion that the market will keep on going like this. So 4 months back, we were looking at clients, and every second client into the market, or 9 out of 10 clients into the markets, were saying that we need 22% average return, we need 30% average return. Our funds have given us 40 to 50% returns. So that was a bare minimum expectation they were having. So they were actually, what we say, that they were captured by the recency bias. When you say that it's a myopic view, because they had seen only the bull run and bull run and bull run over the last 3 years, so thinking that the market goes like that. However, it is over the period of a decade. You can see 4-5 years of the bull run, and then you see the slump. If you see the slump, then it might stretch over a month, it can stretch over a quarter, or even for a year. And I will also show you on the graphically how this is panning out, or this will actually pan out. So here, if you see that where the investor fails himself, because before I could go on analyzing the stock market and the trend, you need to have a right psyche to approach the analysis. But if an investor or you is having a preconceived notion and their expectation, no, I want 22% CAGR returns year on year, or a 50% return CAGR year on year, then whatever the statistics we put to you will be of no use, because you are closed in terms of the knowledge that you need to have, the basic essence of knowledge you need to have in order to have a better returns to the market. So therefore, when we look at, as I've already told you, the factors could be anything. There could be 10 different factors playing around. Every time there will be one factor or the other factor playing out in the market. The matter of fact is how you are then playing your game. That is, so therefore, the first thing that we have seen that in this market fall, the expectations have been shattered. Now you can see the stocks, even the large caps, having fallen by around 20 to 30% for that matter. Many of the scripts even having fallen more than that. So therefore, why it happened? Why an investor failed here? Why the fund manager failed here? Because they were, why I'm saying fund managers, you would have seen they were momentum funds. There were many AMCs or mutual funds that have come with the momentum stocks. So therefore, they were saying, okay, this is a mutual fund category. We are momentum 100 funds, or these are quant funds, because they are building upon the momentum and they are buying based on the momentum and all. Now everything has gone down the drain, because of the, obviously they also have to chase the unrealistic expectation that the industry is having out of them, and also there has been a recency bias. Having seen that, we also have to see now, because once you as an investor are aware now, contained your emotions together and say, okay, now I am serious enough to recalibrate my expectations of what I can expect from this market, then from here you will have to look into assets, how they have behaved, and then you can accordingly take decisions on your portfolio. So therefore, here comes the graph. So this was a graph that I had actually shown you earlier. So this is the daily graph. As we see that, we have seen here Nifty falling from here down to around minus 8.66% as it happened. Okay, so we have seen that, okay, market has fallen down. The main hue and cry is because it has happened, this is a drastic fall, it has happened within 1 month. Because it has happened within 1 month, that is the reason why there's a more hue and cry into the market. The second thing to look at it, but if I can change this graph of a 50-day graph of Nifty into a monthly, you can see here, it is not an isolated fall that has happened. There have been many falls also. So if you see that I have taken monthly, and here we are 2023, here we are 2024, here we are 2022, and here we are 2021. Now, if you see here, there is an 8.63% fall, which has happened over a period of 1 month. Okay. Then here, if we see that just at the end, towards the end of 2023, that is around a year back, there had been around 7% fall in the market. Before that, if you see at the beginning or the end or beginning of 2023, again, you can see it is an annual ritual that is happening over here. There had been a fall of 10%. And before that, again, during the same period between September to January, March, there had been a fall of 18%. Now, if you see this 18% fall, this is happening around the mid of September 2022, and it has stretched till June of 2021. This has happened in 2021. So this has happened towards the mid of September 2021, and it has gone to June 2022. So here, if we see that this has gone towards the end, that is November, December, and it has gone well past 3 months. That means a quarter for that matter. So therefore, the point I am referring is, whatever you are seeing over here, the reasons might be different. Obviously, the valuations of the Indian companies are already overstretched. You can't escape that myth, because if we say that, for example, if there is a company A, so suppose if there is a company ABC, its profit has gone up by 15% in the financial year 24. Okay, now what has happened? Its profit has gone up by 15%. But if we say its current market price, that might be up by say around 60% on annualized basis. Now, this might have happened by 30% in 6 months and then 30% prior to that. The point I am referring is the profit is not growing that much as the stocks have gone up, resulting into extended, or you can say the stretch valuation. Then obviously those things have to fall back. So therefore, a couple of points to be here mentioned is the fall that you're seeing currently in the market is not an isolated fall. It has happened prior also, and it's happened during the same duration of say October, November to January, February as it has gone. The matter of fact is what we have to see is that whether we are able to identify good assets, good stocks, mutual funds, themes to invest into so as to make the big returns coming forth. So it is actually, you can say, periodic breathing that comes into the market for these stocks. So having said that, now the second part comes. So if we have seen here, okay, the Nifty has fallen by say around 8.66% or 8.66%, how that is doing in comparison to different sectors. Now here, if you see that, one more notion I'm going to break is, it is always said that if the market is falling and you want to go for a, you can say, conservative stock, then you can go for FMCG or you can go for pharma for that matter. However, if you would see here we have seen towards the end of September, that is September 20, okay, we have 24. So here we are, this is the hourly chart that I have kept it. So we are looking at September 27th of September 2024. And here we have seen the stocks have started to go down. Now the matter of fact is, while we are looking at Nifty, and Nifty is down by 8.55%, you can see here FMCG. So FMCG is down by 11%, rather 11.5% for that matter. So therefore, what does this mean? This means that when the Nifty is down, it may not be that the FMCG will provide you a good hedge or you can see a conservative asset. So we know that over the last 1 month, there have been many news articles coming up from the head of Nestle to you say the FMCG company, from the ITC and HUL, and they all are saying that because of the subdued demand in urban areas, because of the subdued demand in the rural areas, the FMCG stocks are going down, the consumption is going down, the cost factors have been up, and the costs have been pushing up the bottom line. So the matter of fact is, when the market is going down, it may not necessarily that be that the FMCG might provide you a better hedge, or not even a hedge, at least some cushion for your portfolio. So even if you would have a more FMCG stocks in your kitty, then the case might be your portfolio might have fallen more as compared to the Nifty 50 for that matter. So here if we see that in case of Nifty 50 levels, which are over the same period of last 1.5 2 months, which are the sectors who have done better? It has been CNX Pharma, it has been IT, it has been Bank Nifty, there have been a service sector. So therefore, for the whole 1 year, we had been seeing that for the last 1 to 3 years, we have been seeing that the IT sector had not been performing well, and people and the fund houses and the FIIs were dumping IT stocks. Only recently, over the last 6 months, there had been some buying into it, primarily because maybe the IT companies are having their clients outside India, so therefore they are more or less subdued, saved from those volatility that otherwise is within India. So having said that, these are the sectors which have been higher than the Nifty 50. So then which are the sectors which have performed bad? The metals have been more or less at the same level. Then you have the infrastructure that has been down. FMCG has been bad. Your energy stocks have gone down, like Coal India and all, NTPC and all those things. Then auto, we know that the demand has been very low and there have been huge inventories there. So the auto as a sector itself had been going through the structural problems over the last 6 months rather. So it's no surprise that it is at the lower end of the spectrum. So therefore, many of like Coal India, NTPC, ONGC, many of these energy companies are also one of the very good dividend paying companies. So this also provides you an opportunity to have those stocks in your kitties, because they will be low, they will have fallen by a huge percentage, and therefore the dividend yield would be much better. So there will be dividend opportunities that will be coming up. So therefore, if we see from this sectorial comparison, what we come to know? We come to know that even if FMCG was historically assumed to be a conservative sector to invest into, and therefore the fall in equity markets would not have been too much as compared to FMCG, like FMCG would have fallen less as compared to the Nifty 50, but here the myth has been broken. So you have to see that the numbers, the fundamental numbers of those sectors should also be in sync with. If there are all other variables okay, doing fine, then it might do well than the Nifty. But if those metrics for that sector specific, like FMCG, if those metrics are not fundamentally doing good, then obviously it may not cushion well, and rather it will fall more than the Nifty. So therefore that is a key. That's the key. Now this brings us to the next most important comparison as we see it, is the market capitalization. We know that okay, when the market goes down or when the market falls, so we know that the Sensex falls more, Sensex falls less as compared to mid cap or the micro cap or a small cap stock. So that is the reason why we say that okay, you need to hold on. If there's a market volatility, if the market is correcting, it's better to have the large cap companies, or you can say the blue chip companies, so that the fall is not that much, or it will provide you with more stability for that matter. Now here, if you see this graph, here what we have done is, here we have taken a Nifty 50. Then we have taken Nifty small caps index, and we have taken the Nifty mid cap, and we have also taken the micro cap. So here we have taken micro cap, mid cap, and small cap, and we have seen that how these three have performed vis-a-vis Nifty 50. And you would be surprised to see that in this case, when we say Nifty, here we have taken the, I have not taken the exact date of 27, here date थोड़ी सी पीछे हो गई है. So here we have around 17th and 18th of September 2024. So here, even if we take this as a date and not this as a date, I have taken this as a date. Here the difference would have been more stark. So even if I've taken this as a date, we can see here Nifty had been down by minus 5.57, whereas micro cap had been 3.18, and this is 5.57. This is 5.57 if I am taking from 17th of September. You would see that from 17th of September, Nifty had been down by around minus 5.57. And when we have taken the fall from here, say from 27th, if we have taken the fall from 27th, the fall in Nifty had been around 8.86%. Now the matter of fact is, as the fall is 8.86%, and for others that was around minus 4.5% or minus 4.74%, as it goes for mid cap and small caps, or even for that matter micro caps. So matter of fact is, if you see this as a graph which is called as a micro, the micro cap had fallen drastically here, but the recovery has been huge. So they had fallen and then the recovery has been huge. They have fallen and the recovery has been huge. So therefore, if you see here, so what does this show? That this shows that it may not be necessary when the market are getting corrected that the mid caps or the small caps will obviously be more volatile, but they will, कहते ना कि they will fall more than Sensex. It may not be necessary. There might be recovery which might be faster than in the Sensex or the Nifty. They are more reactive to the market news, and so these are the things that I wanted to bring up to your notice, so that when you view as a market and you have certain preconceived notions and fundamentals with a changing market scenario, because in Nifty 50 there are only 50 companies, but when you go for a small cap or a micro cap, there's a broader stock base available and much more better and more you can say democratic stocks available to you for investing. So therefore that's the reason why the recovery and fall are not that steep as when we consider the Nifty for that matter. So now here, if we see okay, how Nifty as an asset class has performed with regard to the gold or the global funds. So here what we have done is, here we have taken the start of 2023. Here we have taken the start of 2023. And here we are here. So here if we see that ki bhai Nifty ne bahut acha return diya, you'll be surprised to know that the Nifty has given 31% returns. So if we say that if you are in January 23 and we are now at November 24, we can still say that Nifty had given 31% returns. Okay. Now during the same period, if we say the NASDAQ has given around 81.55% returns. Now, if you see that this is Nifty and this is NASDAQ. So while the Nifty has been going up and up, the NASDAQ has much more steeper. There had been great fall here, but then again it recovered back and it moved up. So therefore, so this is one element to it. But say from the 1st of Jan 2023 till now, if we compare it with regard to the gold had been only 36%. So you have Nifty at 31%, the gold has been around 36% for that matter. Now during the same period, if we consider Hang Seng, or you can say the China, or you can say the Hong Kong, it has been around 18.9%. So yes, so we have here 18.19% Hang Seng. So that this upswing in Hang Seng has happened recently because we are looking at China's stimulus. Now the point is whether you want to enter into this space to ensure that you not only diversify your portfolio but also make a return on the top of that. So what does this mean? This means that while we were many people of us were happy with the Nifty making 31% returns, the global US had already made around 81% returns on the top of that. In recently, we have seen Hang Seng picking up because the China stimulus is on the way. That is one of the key reasons in the first slide that I had showed you, that apart from Fed rate, the Hang Seng is also there because China is contemplating the stimulus inflow into the Chinese market. If that happens, the FIIs might push the money there, and then we can see spike. Hang Seng corrected in the recent past, but that is one more great challenge to India apart from the Fed rate decision. Now, यहाँ तक बात हो गई. Then the next thing comes how the Nifty has been doing with REITs, real estate investment trust, because they are also available on the equity markets. They're also good for the stability of the portfolio. And here, if we see that, we have taken nearly 3 REITs. One is the Embassy Office REITs, one is Brookfield, and one is the Mindspace. So as we say that, as we've taken this, we have taken here the date as 27th September 2024. And as we say that, the stock market, we know that it has gone down by around 8.43%. Yeah, 8.66% like in previous slide. वो एक दो दिन की वजह से फर्क हो जाता है. Now during the same period, if we say here, we have Mindspace. So Mindspace has given like 6.10%. You have Brookfield that has given 3.42%, and you have Embassy Office that again has given 3.34%. Now the matter of fact is they provide you rentals in the form of the dividends, and therefore whatever the returns you get also credited. Though this is the gains that you're, this is apart from the dividend yield that you're getting. So dividend yield आपकी 6% हो सकती है. So you will be getting an annual yield of, say for example, 6%. Apart from that, during the same period, the value of the REITs have gone up by around 3.5 to 6% on the capital gains mode. So this is how they have performed as compared to the Nifty. So therefore, when you're considering an equity portfolio, and people also go for different asset class to, you can say, they hedge the portfolio, not even hedge, even to stabilize the portfolio. So therefore, the REITs is one more options you can consider. And therefore, normally it is said that if you get a good opportunity, because there was a time in 2023 when the REITs had fallen drastically. That was a very good time to get into the REITs, because then the yields would have been much more better than that, because after that there had been steady increase in the REITs, because at the end of the day what REITs does is provide you the rentals in the form of the dividends compulsorily paid out to you, and 90% of the dividends, 80 to 90% of the dividends have to be paid out to you as per SEBI guidelines. So therefore, what is the way ahead for you in this case? So if we say that, so there are the 3 steps that you need to take. Now this is the first video that I am doing today. The second video will come in a day or two, where we will discuss what the strategies we need to follow for you to obviously work on your portfolio and then just stabilize the portfolio. The first thing is that there are new market dynamics. There are new market dynamics into the market. So therefore, you need to have a new strategic approach. So what does that mean? So if we say that initially we were going for momentum strategy. Now that momentum strategy might not be the good one. So therefore, there might be the strategy we need to go for the value buys. So we need to go for value buys, or you can say picks. So these are the first things. The second thing is there when we talk about the tech strategies is whatever the gains have been there, the profits that have been booked, there will be an outstanding capital, you can say tax on that. So therefore, because the markets are down, the stocks are down, this provides us with a very immense opportunity to book the unrealized loss, to do the tax loss harvesting, reduce our tax liability to zero. And with the corpus available, that would have served us two purposes. First, our tax liability would have been made zero. After tax liability being made zero, we will be having surplus cash with us so as to deploy them as per these value picks. So the second step, which is actually an reducing of the tax outflow by means of the tax loss harvesting, doing that step will enable us to have funds to go for a strategic value picks. And then from there our returns would happen. So not only we would have reduced our tax liability, but our portfolio would have been structured from the new strategic approach of the portfolio. And at the end of all these things, anything and everything is immaterial if we have not got our psyche right as far as the market is concerned. So if you still think that no, I want to make 30% of the returns into the market, the 40% of the returns into the market, then you will be always the first person to lose money into the market, because even if you are getting 20% return or 18% return, your expectation is 25% return. अगर आपको 18% आया, आप तो ये सोचो कि यार मेरा 5% का नुकसान हो गया. You're getting it? So if you think that you want or you deserve 22% of the returns into the market, when the market's the long-term average ही 12-15%. And we have been telling it way to our clients over the last 3 years also that if your portfolio is currently giving you 20 or even 40% for that matter, and the long-term average is 15%, then eventually in a year or so or 2 years or so, the returns will fall. They have to match with those 15 to 18% returns. And that is what exactly has happened now. That is exactly what has happened now, because we were having 20 to 30% return, 40% return. Now the valuations are being cut, the money is being sucked out, the stocks are falling. The average return will taper down onto the same levels as we see. So therefore, whatever you say, do, or whatever the science, the art you apply to your portfolio, whatever the tips you get on to the stocks, at the end, what matters is how you are psychologically oriented to it. If we are investing into a stock thinking that in 6 months or 9 months I will make money, everybody knows that stock investing is a long-term game and we need to be invested for a set period of 5 years to 8 years. Now, if you're invested into the market and you have entered in 2024 or you have entered in 2023, you have not given even a 2.5 or 3 years of the run. How would you expect to make returns into the market when there is a fundamental thing like for every 4 or 5 years of the bull run into the market, there happens 1 to 2 years of the bear phase, not even the bear phase, stagnant phase, oscillatory phase, or range bound phase. If that oscillatory or the range bound phase is there, you will not be able to make money. So what would happen? You will become disenchanted with the market and thinking that it is all sham and I'm not able to make money into the market, and you will be the first one to come out of the market exactly the moment when the market is going to see a turnaround, then going up, and then you will wait for next 6 months to wait for the market ki bhai main ghusunga nahi ghusu, and when you decide to get into the markets will again be falling. So therefore the matter of fact is, while you as an equity investor are looking at investing into the equity portfolio or any portfolio for that matter, you need to have you can say the guts or a right psyche or frame of mind. So the point is, if you are a marathon runner, you can't be having a psyche of a T20 player. So for a marathon runner, the psyche has to be totally different. So therefore, when you're going into the equity markets and you need to see the full run of 4 to 5 years for your portfolio to recoup and recover, you can't have the same strategy running here with the same things going in and out for that matter. So this is what I have to say. So if any queries, I will be very happy to hear more from you. And anything you can write down to me, tag me, and it will be really fun to discuss things with you. Thank you so much. This is Rajat signing off.